Hey everybody, good morning. How's it going?
Hey, good morning, Pete. Happy Saturday, everybody.
Happy Saturday. Happy Saturday. Wow, I think capital V for volatility this week.
Yeah, absolutely. Volatility is back. It is definitely back. I mean, it dropped off a little on Friday. We had a little bit of a rally on Friday, but it's definitely a higher environment than we've been used to the last couple of weeks. That's for sure.
So I think a little bit of I don't know, say disconnect, but the Dow got all the headlines on Friday. It seemed like the press was very excited about putting up the percentage and the dollar amount, the points that the Dow was up. Digging a little bit deeper, looking into some of the others, such as the SPY and the Nasdaq, which we'll venture off into the Magnificent Seven in a second. Again, the SPY did not hold near the highs again, which you can see here was pretty much a theme for the week, where we could not close strong in the SPY. Do you read too much into that, John, or am I reading too much into that, or does a strong close matter?
I don't think you're reading into that at all too much. I think that when you have an upper shadow like that, it is showing relative weakness. It's showing that there are sellers still out there. It's very important to realize the Magnificent Seven, depending on market cap, ranges between 31 and 37% of the S&P 500. So, when those names get sold off, it's going to affect the S&P 500. So that's why it's so important to do the analysis that we do every week and to be in the right names if you are still bullish in certain areas. And it's important to start being balanced and start looking for bearish opportunity as well. There are plenty out there.
I did write, yeah, I did write about that a little this week. I might just start looking at straight out bearish ideas. We've been spending a lot of time on Saturdays talking about they have not followed through because the bigger picture was just so overwhelmingly bullish. They sounded good as a hedge. You were shorting weaker stocks, but we're just getting them shoved in our face. But this picture actually, I think, is pretty telling. This is a Magnificent Seven.
There you go. And look at the size of those boxes, by the way. You know what I mean? They're just big companies, so they're going to affect the S&P disproportionately. You know what I mean? And that's what we're seeing, and that's why the S&P did not rebound as much as you would have liked. Even though we had really pretty cool numbers this week, we could talk a little bit about those. But the economic news still rolls along pretty positive, especially GDP quarter over quarter was great, fantastic, 2.8%. But you have these, you have this hangover of these Magnificent Seven names where they're getting sold off, and it's sort of healthy because you want to see some profit taking, and you don't want to see them to go to nosebleed levels and keep going higher. So, I mean, think about how long they've been holding the market up. They've been holding up the market for the better part of a year. So it's only a matter of time before the air comes out of the balloon a little bit and institutions start to reshuffle and rebalance, and that's pretty much what's happening.
I think that it certainly feels that I wouldn't say complacent as much as you didn't necessarily need to look that hard for ideas. Tech was strong for probably 18 months, coming off of, let's go all the way back to October of 2022 when ChatGPT started to come into the universe.
Mm-hmm.
And it was bullish. It was carrying literally everything. We're not in that environment anymore, and I just want to give everybody a heads up. And I'm going to say this a certain way, John. Let me know if you kind of feel the same way. But we're kind of getting back to a normal market now, where we had this mania, for lack of a better way of putting it, where everything was bullish. And I saw this in a lot of game plans, and I started to really kind of level people back. I'm like, you're getting away with it now because everything's going up, but picking bottoms and getting involved in stocks because of how far they fell. You can get away with it in that market when the undertone is so bullish, everything's getting carried, and that's great. I want to be clear about that. It was great that we experienced that, but we mentioned a month ago that a lot of these stocks were properly priced, and separating the company from the stock being properly priced and expecting future appreciation. And we're kind of seeing that now. So if everybody who's like, oh, woe is me and all that kind of stuff, I just want to throw some cold water at you. This is now back to a normal market where we have to pay attention to where the money's flowing outside of that mania.
Yeah, 100%. I mean, one of the charts you could pull up, Pete, is RSP. I think that's something everybody should put on their charts now, because what it will do is show you what the real market is kind of looking like. So RSP, for those of you who don't know what it is, it's an equal weight ETF for the S&P 500. So it takes all those big boxes that you see, you know, the Magnificent Seven, and shrinks those boxes to an equal size of everything else. So as you can see, that was a really nice bounce on Friday if you kind of look at it from an equal weight standpoint. So I think the overall market, although there's more bearish opportunities because these stocks are rolling over, there is still a bounce to some of these quote unquote normal, for lack of better words, the normal names. You know what I mean? The non-AI, the non-Magnificent Seven names are really starting to still continue to go higher. But the question is, because those other names have such a large percentage of the S&P, will that take the whole market down is the big question. And that's the question that hasn't been answered yet. So we do have to be a little more bearish. I agree with you there. But that does not mean there are not great opportunities. I mean, look at all that green in industrials. Look at GE. Look at Lockheed. Look at Boeing. I could keep going on and on and on. There are pockets of opportunity.
So I have heading into next week, healthcare, industrials, and financials, which I think would be fantastic because those are some pretty big areas of growth. And if they could pick up the steam, you know, again, we spent massive amount of time talking about the beautiful rally that we had for a while there and how it was all focused on just a core group of stocks. And what if the Magnificent Seven does not carry the market? We're kind of feeling that a little bit now. But if these other sectors can kick in, obviously we're going to talk about the Fed coming up next week. We're going to be okay. It's just got to just do that little bit of extra, game planning, for lack of a way of putting it.
Yeah, absolutely. One of the things I'm really going to look at, I'm going to add to my weekly routine, is that RSP chart, because if that trend breaks, that's going to tell me that the overall, the big names like the Magnificent Seven are taking over, in other words, right? So if that trend breaks, if that does not continue to move higher, then I'll start to be concerned about the overall market and I'll get more bearish. So I'm going to start looking at that a little more closely. But, for the most part, we have a very heavy earnings week next week. There's going to be some very interesting data. You might see some stuff. You might see some of these tech names bounce next week because of it, because you have some of these names reporting. But just as a general, just showing you how things have smoothed out. The Dow Jones used to be, I think, only up 2 or 3%. It's now up almost 8% year to date. You have the S&P, which at one point I think was up like 18 or 19% on the year. It is now only up 14.4%. And the NASDAQ, which was like up, well over 20%, it was up quite a bit, has retraced back to 15.6%. So what I'm trying to point out is that the overall indexes, the overall market is actually starting to smooth out. And the Russell, let's not forget the Russell. The Russell was, I think, in negative territory at one point for the year-to-date return, and it is now up 11.4%. So the numbers that I mentioned, 7%, 14%, 15%, 11%, those numbers are all close together. You know what I mean? And we're seeing a smoothing out. I know it feels painful if you're in some of these names, right? But you see a smoothing out of the overall market, which I think is healthy. The only problem is there's such a big weight, some of those large cap names, that it could drag things down, and that's what we have to kind of watch out for.
I think something that we have to be careful of as well is we start to get used to these 30, 40, 50, 60, 200% moves in stocks over a month. And then, like what you just said, let's even use the average of those four indices that you just mentioned. Let's say it's 12% for the first 7 months of the year. That's fantastic for an indice for half the year.
So we're kind of seeing a reversion to the mean, I guess, is what I'm trying to say. These crazy high-flying names are starting to pull back, and the money is not leaving the stock market. The money is going into small caps and industrials and healthcare and financials. So that's a good thing. That's good news. We have a Fed meeting this week, so we'll see what they have to say about that. And I'm still somewhat bullish in that aspect, I think, but we have to be super selective, and that's the key. Like like what you said, just kind of picking bottoms and trying to jump into things used to work, but now it's not working anymore.
Yeah, I think the raging bull market was masking a lot of aggressive, I'm going to say bad decisions, because I'm not a big fan of buying stuff while it's still going down. Somebody had asked us last week, what's the difference between bottom fishing and picking a reversal? At least on a reversal, you have some proof that there's a bottom there. You have a support level as opposed to going down. And it actually, Lulu, I don't know if Steffi's on the call right now, but Lulu was a good example that it's still going down. But if you take a look at the candles, the volume after this big move to the downside, there's a chance that that was exhaustion, which basically meaning it's a capitulation print or the end of this big selling order. But that doesn't mean you buy. It means that you get more aggressive moving down a trailing stop loss as opposed to looking for a trade in the other direction.
Yeah, that does not look like a pretty chart. It's not a train I want to get in front of, that's for sure.
No, exactly.
Definitely not. There's a lot of charts that could look like that, and you don't want to jump in front of that train. And I think another thing to think of when you're considering bottom fishing, or whatever you want to call it, bottom feeding versus trying to catch a reversal move, one is trading and one is more investing. One is a little more longer term in mind. Like if you like Lululemon for the long term and you think this is a unique opportunity and you want to hold the stock for 5 years, go for it. You know what I mean? But that's not trading. That's not what we're talking about here. This could continue to go lower. And if you want a dollar cost average in your portfolio and accumulate a position like for an investment, that's a different story. But that's not, with trading, you don't want to have dead money because the whole idea of trading is to move capital around efficiently and to find the best trades possible to generate monthly revenue. That's not what you're going to do with Lulu if you buy something like that.
Yeah, you mentioned a good point there, which I've seen a lot of day trades turned into swing trades trurned into investments just simply because of blowing a stop loss.
Yeah, because now you're married to it, and then something in your process went awry at that point, and that means that you had a plan for the trade and you blew past your plan. You decided to keep it, and you did it in the middle of the trade, which is a no-no. That's trade management 101.
There's so much opportunity, and I know guys, people on our side of the market really probably tired of me saying this, but I have to keep saying it. The number one reason to stick to your stop loss is there's so much more opportunity. Why would you hang on to something that's proven to not be working when you can get your money back and then put it into the next idea? It just doesn't make any sense. But like you said, we do get an emotional attachment to the idea.
Yeah, the idea of capital allocation is really important with trading. Everyone has limited resources, no matter how much money you do or don't have, and you don't want to just sit there. You know what I mean? And that's trading. So you're going to take that money and say, okay, I'm stopped out. I mean, it doesn't mean you can't get back in if there's another potential good entry point down the road. But if you don't get out, you'll never get those opportunities. So from a business management standpoint, if you're running a business, which what we are, if you have limited resources like every business has, you do not want to miss opportunity costs. An opportunity cost is something that people overlook. Blowing past a stop and turning a trade into an investment because you're married to something now, you're wasting time and capital. And that's something you have to kind of realize.
Why do you think people do that?
I think a lot of it's mostly emotions. Some people feel like, maybe my stop loss was too conservative. Maybe I should have, maybe I'll give it a couple more pennies or I'll give it a couple more, whatever, call it $1, then they'll make up something outside of their plan. So they'll like, let's say you had a stop loss at a 20-day moving average. I'm just kind of making it up, right? And then you look at like the broad market, and let's say the broad market went down to its 50-day moving average, right? So you're like, oh man, I was too conservative on my stop. I should have used the 50-day moving average. So now you change your stop based on what you think, or you're trying to make stuff up as you go along, in other words. Now, what you can do is you can get out of the trade at the 20-day moving average like you're supposed to, right? Watch what happens. And what if you get a reversal at the 50-day moving average? Well, okay, maybe there's another opportunity there. Maybe you could have jump back in at that point. You would have never been able to do that though, because now you're sitting in a massive loss, and now you're mad, and now you're married to the position. And
I have found actually also when I both at my firm and when I do one-on-one calls, and this is a really weird answer for those that aren't full-time traders. Um, a lot of people don't get out of trades because they're afraid it'll go up after they get out.
Yeah, I mean, well, what are you afraid of exactly? Are you just going to get mad at yourself? Like what? I mean, yeah, that could happen. It could definitely happen. But I look at it as the trade you picked at that time did not work. So yeah, could it go back up? Sure. But what if it takes a whole week? Again, opportunity costs. What if it does go back up, but it takes a few days? You could have been doing something else during that time.
Yeah, I choose to look at the other side and say, but what if it doesn't?
Yeah.
What if it continues to go in the other direction because it's already validated in the time frame you plan to put the trade on? I'm much more conservative on the side of I'd rather be aggressive with protecting capital than worrying about if that opportunity that's not working will turn around.
Yeah, that used to bother me when I was first trading. It doesn't bother me anymore. I look at it that way too. Well, anything could happen, right? And that particular trade at that particular time did not work for me. End of story. And I'm not going to give up opportunity costs. I'm not going to take that capital and let it sit there and do nothing, or even lose more money potentially, and not move it somewhere else.
Or worse, try and get more of it, because in your mind you start to be like, okay, I could just. If I got it there and I get more shares down there, and if this thing just comes back halfway, then I'll end up being okay. I swear I'll get out for a flat if I have the average price.
Right.
In my experience, I have found bad ideas stay bad ideas.
Yeah, something. There's a term very technical term for that at the trading desk I used to work for. It's called doubling down on stupid. Because it's already a bad idea. It did not play out. For whatever reason, it wasn't a bad idea. It just didn't work out. But now you're doubling down on something that's bad.
Yeah.
Well, again,
I think there's too much opportunity to hold on to something that's validated. It's not. And one thing also, I know we mentioned this before, but it bears mentioning again. If you're that attached to the idea, okay, hold on to some of it. You don't have to hold on to the whole thing.
Yeah.
Cut your shares back by 2/3 or whatever the number is.
Yeah. Sometimes people trade what they like. That's a phenomenon too that I've noticed. I have an iPhone, so I'm going to trade Apple, or I drive a Tesla, so I'm going to trade Tesla, because they feel like they quote unquote know the company. They're comfortable. If they buy their products, they're like, oh, well, that's a great company. Like Lululemon's a good example. Like you walk in that store, it's nice. You know what I mean? They got nice stuff in there. But look at the stock price. So you have to kind of disconnect your human emotions from a stock chart.
Speaking of that, let's actually talk about Tesla for a second. Had this massive rally over here.
Yep.
Off of delivering numbers that were not as bad as expected. So not even good, just not as bad as expected.
Don't you love that when less bad news becomes good news?
Yeah, massive volume on that move to the upside. But then again, for probably like the 7th or 8th earnings report in a row, they're still complaining about margins or admitting that margins are a problem. And the part that Tesla maniacs don't understand, that I don't understand, is they had these huge margins selling the $150,000 cars, and that's fine, right? That was great. Got the company off the ground, all that kind of stuff. But now all they're talking about is the mass market car that's going to have even less margins.
Yeah.
So where is that going to get turned around?
Yeah, that's the problem. Like, Tesla had the first mover advantage. If you go back to like Porter's book, right, of all the different, competitive advantages.
Yeah, that's a great book, by the way.
It is a great book. And so one of the things he talks about is, the first mover advantage. And I think Tesla certainly had that. And now it's starting to dissipate. So it's painful. And that's what we're starting to see. And it happens when a market gets mature. The EV market was not mature 10 years ago. And now it's starting. I would even call it mature now. I think it's starting to get there. But you have all these new companies. They're poking around to see if this is a viable part of their business. And they're starting to realize that it is. So now you have GM, Ford, Audi, BMW, Mercedes, with all these massive resources behind them. And they have obviously 100 years, in some cases, a whole century of car technology behind them. Now, what the Tesla fans will counter-argue, they'll make a counter-argument to that and say, well, Tesla's not a car company. Tesla is a data company or a tech company. And I would agree with that, but then show me the money.
Right. What are they doing? It's like AI right now. What are you doing with the software?
And it becomes a show me story then. And if it's a show me story, then the stock is currently overvalued, and you can get into the fundamentals, which we don't do here. But you can say, well, okay, so Tesla might be worth 10x in 10 years, but right now it's not. So from a trading perspective, it goes back to taking your investor hat off and putting your trader hat on and saying, okay, Tesla might have a fantastic future. They might have robots all over the place, right? And they might go to the moon and Mars and all that stuff. And then, you might have someone might have a robot in every house, right? In 10 years from now for $10,000 to clean your house and to like do your laundry and everything else. Sounds great. But it ain't here yet. So we'll see. Right now, from a trading perspective, it's just, that there's too much competition, and these other companies are starting to eat Tesla's lunch.
I got two things. Number one, have you heard what robo taxis actually are? Like that's the next big thing. Like at the press conference when they announced last week, he's like robo taxis by January. I'd be shocked if it doesn't happen. It's basically like you let your car go out and do Uber by itself without you in the car. Like it's the craziest thing I've ever heard.
I mean, it's just, I think it's great to think of the future and to think of all these great things. And the technology curve is very steep. If you look at where we were 50 years ago versus now, right? Compare the last 50 years to the last 10 years. And you can see that, the technology curve is getting kind of parabolic, right? Yeah. Ever since the iPhone, ever since digital stuff and whatever. And again, I'm no expert on this type of subject, but what I see is a huge transformation in our society. But I think because everybody's so innovative and thinking far ahead and everything else, that, back to reality, back to looking at charts and being a trader, that could happen 5 years from now, 3 years from now, all that stuff. But is that going to help you this week? Is that going to help you this month? No. Now, when it does start to happen, we'll see it happen. We'll see Tesla start to break its moving averages. We'll see volume triple. We'll start to see, the talking heads on CNBC talk about Tesla every 5 seconds. And you'll start to see certain things, causing the stock to continue to go higher. Right now, it's kind of like a show me story, I think.
I'm not a big fan of, and I've said this for a long time, I'm not a big fan of a CEO spreading himself that thinly. I'm not a big fan of that. He's got like 5 or 6 different companies. I know he's talking about going to Mars and into space and all those kinds of things. But at what point do you separate the celebrity CEO from the actual numbers?
Yeah, and I agree. I think that's another thing. Elon Musk is obviously a very smart man, maybe too smart because he's probably bored of Tesla. You know what I mean? He wants to do other stuff, which I completely understand. So what he should do is delegate a little bit better. We'll see if he does. Maybe as things progress with his other businesses, that'll happen. And that'll actually be encouraging. I think if he said, okay, so-and-so that I've been working with the last 20 years, he knows Tesla in and out, kind of like the Tim Cook of like Tesla, put someone like that in charge. Someone who's good at the numbers, someone who could run a car business, but someone from the inside,
He did have, he gave that to somebody at Twitter, now X.com, Linda Yaccarino, but he seems to be on there all day, every day as well. So yeah. I don't know if that really solves anything.
Yeah, I mean, I think he likes, that's his pulpit, so that's great. But I think, doing that with Tesla would be helpful, I think.
I agree. So Michael's actually asking a little bit of a out of the box question here. Any insights on the yen carry trade unwinding and strength potential impact on the U.S. indices?
Well, yeah, I think a while ago, I think it would have been more of an impact because I'm not a huge currency expert. I used to trade currency back in the day. The yen is a risk-off currency. So when you see the yen strengthen, it could be like a concern. As a general rule, when you see Swiss franc and yen in general go up and get strong, you say to yourself, okay, well, what's happening? Is the dollar declining? Now, believe it or not, comparing the dollar to the yen, the dollar and the euro are kind of risk-on currencies, like from a trading standpoint. What I mean by that is, since we export a lot of stuff and we're very economically driven, those currencies are strong. So what he's referring to, I think, is, as the yen strengthen will cause the dollar to weaken. It could, but the question is, will a weak dollar be bad for the U.S.? And my argument to that would be not really. If you have a company who does a lot of exporting, like the U.S., a weak dollar doesn't necessarily hurt us unless it gets really weak. Because if it gets really weak, then the stuff that we try to consume and import will be expensive. So it's a very tightrope, I guess you can call it. But since we're lowering our rates, I think it'll make the dollar a little bit more attractive. I think we'll see it kind of level out. But it's something to watch for sure. But it's not something right now I'm too concerned about.
Also, a very big X factor is, again, not being political at all, but the Republican side argument right now is the amount of tariffs that they're considering.
Yes, an increase in tariffs will definitely hurt some of the trade, but you could get into a trade war. But since the U.S. is still the largest economy, we have like that a little bit of an ace in the hole in that aspect. So we could start messing around with tariffs, but we have to be careful. You know what I mean? And we definitely can't overdo it. I think Biden I don't know if he recently did it, but he put some tariffs on Chinese EVs. Or he maintained the policy from the previous administration. So I don't, but it does affect things, because you could look at some of the EV companies in China really got hurt that way. Now, if that gets too out of hand, China could turn around and retaliate, right? And that's what you don't want to see. But I think that as long as that type of policy is well maintained, but the problem is, again, you get ahead of itself and people start to worry about, well, what's going to happen and how many tariffs are they going to be? So that is a worry. It is definitely a concern when you over tariff, your partners. But it has to be done thoughtfully. But at the same time, it can't be done across the board very quickly. And I think that's the fear that you're referring to, that it gets done very quickly.
Yeah. How much is it campaign rhetoric versus they actually plan to do it?
That's the thing, they might, because it is good, from the pulpit, right? Talking about, hey, we're going to, we have to do what's fair. We have to be competitive, blah, blah, blah. But then the question is, what do they actually do? Is it 20%, 10%, 5%, 30%? And then when do they do it? Do they do it right away? So what they really do and what they say might be two different things. And that's both administrations,
Yeah. Yeah. So obviously we had some economic data on Thursday and Friday this week. Both of them came in above what was expected. And on the surface, you'd be like, okay, that's not good. But that opens the door again for the possibility of the Fed on Wednesday. I don't think anything's supposed to happen. I think it's widely accepted right now. I don't know what the percentages are, but it looks like September is going to be when they actually make their first rate cuts.
Yeah. 88% probability.
Is it up that high now? Yeah.
It is now 88%, which I think they're only pricing in a 5% probability for Wednesday. And that is not a prediction, so don't quote me on that. But if they were to raise on Wednesday, I wouldn't be surprised. And I think 5% is way low. I think it's more like 20%. Like, I wouldn't be surprised if they lowered rates on Wednesday. Now, if they lower rates on Wednesday, that doesn't mean they probably won't do it in September. Keep in mind, we have an election, right? So if I was them, I would probably do it Wednesday. If I'm going to do it, I'm going to do it early and not deal with the election cycle. That's what I would do. But I don't know how much Powell cares so much about that. I mean, they try not to get involved in politics, which makes sense. So if I was him, I would factor that into my decision making. If I know I'm going to lower rates, does 6 weeks really make a difference?
And
right?
When just ahead of the election, that kind of stuff as well.
Yeah. So you don't want to start doing it in September even. You want to do it now. So
that's what, so I mean, exactly.
Yeah. So I think 5% is ridiculously low. I think there's a good chance. I think 20% chance. I mean, not a great chance, but they'll do it on Wednesday. So don't you might get five
reaction to that happening out of the blue.
I think markets will rip and then what'll happen is you'll see a sell off, because it'll be like, okay, what's next? Are we getting, or if there's guidance, like what if they lower and then say, hey, there might be another one, that'll make the markets rip. But if they say, okay, one and done for the year, and if they're very clear about that, and they kind of go in that direction, then you'll see initial euphoria, and then you might see a sell off.
So everybody, this is this coming Wednesday, just so everybody knows. We're not talking about some distant future. This is Wednesday afternoon. And then we also have non-farm payrolls coming out. So I guess really a lot of the economic data that's been coming out has not really forced the Fed's hand at this point.
Yeah. There's been
Really, it's been kind of like Goldilocks, really.
I mean, that GDP number, man, 2.8%. That was nice. That's Goldilocks. It's not 3%. It's not 4%. It's in the twos, but it's in the high twos. That it doesn't get any better than that as far as Goldilocks scenarios go. And the PCE was in line on top of that. I mean, you got Goldilocks right now, so they can lower rates on Wednesday, and they have the justification to do that.
One of the parts that I'm speaking to everybody that I'm, friends with, people that don't know the markets or anything like that, nobody feels like inflation's come down. I don't know how it feels in different parts of the country and whatnot, but I don't know where everybody else is, but prices have not come down anywhere to reflect the inflation numbers that they're talking about right now.
Yeah, that's the CPI data. It takes out food and there's food and energy, which is the two. Obviously the most important to us.
Yeah, exactly.
The PCE takes out food and energy. So that number has been, it's starting to come down, but it was in line. It's still sticky. It's still kind of sticky. So services, food, and energy are the sticking points. And obviously everybody feels that when they go to the store or they go to a restaurant or the gas station. So you're right. For the average consumer, it's frustrating. But the numbers that's what they're looking at.
Yeah, so Brad's kind of saying the same thing here. Again, I'm not a conspiracy theorist. I'm not saying manipulating or anything like that. But you go out and two people have lunch and it's $45. You're like, what planet do I live on?
Yeah, it's unfortunate. And then you have size inflation, right? You ever see the size of the steak you get now? I mean, I remember maybe it's because I was 11 years old when I used to go to the Sizzler, but the steak was huge. I couldn't finish it, right? Now you go to a restaurant and it's like 6 ounces, and it doesn't even look like 6 ounces. It looks like 2 ounces. Maybe it's because now I'm old and I'm bigger, but it's like I just feel like the sizes of things have gotten smaller too.
And prices haven't come down with it.
Yeah, so I think there's that too. So it's just there's all kinds of stuff going on, and I think inflation is still here. So maybe Powell recognizes that too, and that's why he's taking his time.
So what are your thoughts on a company that has a 50-to-1 stock split that is now under $50? That a month and a half ago it was $3,200.
I don't really like Chipotle, so getting back to liking the stock versus the stock itself, I don't like the chart or the restaurant. But yeah, so yeah, that's just it just shows the lack of appetite, no pun intended, for those types of names.
We're seeing a lot of them come down actually right now. McDonald's is actually even pulling back as well.
Some of these well-known names that they have goods and services, like in Disney too. Not that Disney's in that genre, but like you have these names that are just like in the toilet and they're not really recovering. And it's because nobody wants to pay $40 for a Big Mac and a fries, and no one wants to go to Disney and spend $600. It just is not in people's budgets.
So kind of winding down, getting more into the bigger picture stuff. You mentioned before, money's still flowing into equities. Obviously, this would need to start to rally for that to change, and it's still on that support level. The lower this goes, the more money's going to stay on the equity side of things.
Yeah, so 2 charts that you guys should definitely be watching. Like I mentioned, the RSP chart is a cool one to look at just because of the situation that we're currently in, right? And then this one, because this is obviously the 10-year yield. It tells you pretty much, okay, well, is money going to flow into equities or stay in equities, or if this starts to break its downtrend, you might see more money going into fixed income, and that would be bad for stocks. Because it all goes back to institutions. If people are scratching their head wondering why, if a big bank or a big hedge fund or a big mutual fund could get 5%, which it's not getting right now, but if they could get 5% in a 10-year treasury, it just makes logical sense for them to move money out of equities, especially if they have double-digit returns on the year so far, which they do, and put it into fixed income. And that hasn't been the case yet, but that's something to watch.
So I've been reading a lot about sticking with the 10-year treasury yield. We haven't mentioned the inverted yield curve in a long time. There were a lot of popular podcasts out there for months talking about the inverted yield curve historically leading into a recession, and that was masked. I'll keep using the word masked by the AI mania. We got hit with this bulldozer of a move to the upside, but the yield curve, it's inverted for the second longest period since they ever tracked it at this point.
Yeah, it's definitely what, 400 and something days. 400.
Yeah.
I mean, it's very hard to look back at all that history and say, this is a unique time in history. You know what I mean? We could point to AI, we could point to some of these names and say, well, because of this, it's okay if the yield curve is inverted. But I think a recession is not off the table. That would be the black swan for next year, right? We get a recession.
That's what I was implying. Was it delayed because of AI mania?
It could be delayed, and I could tell you there could be some, there's some things out in some dark cloud cover without being negative Nancy here. You have
balancing that act right now, not to be negative, but just giving everybody something to think about.
Well, you have the debt burden, right? The national debt, and this has nothing to do again with politics. This is both sides of the aisle. They can't get it together and manage, balance the debt, whatever. So you have this debt that's increasing as a percentage of GDP, right? That needs to get fixed. And then you have on top of that student debt. On top of that, you have credit card debt. On top of that, you have mortgage rates that are still sticky. There's just a lot of debt out there. So I think that could be the thing that causes, things to kind of roll over. Even auto debt, you name it, it's out there, and it just keeps going up. So, we're kind of, and we've always, America's always been like that, very heavy on debt. But now it's the point where wage growth is kind of not that great. And all it would take is one or two bad things to happen. And then, we could be in a recession. So it's just something to think about. And the yield curve is kind of pointing to that.
So we all got to brush up on short selling, which we have plenty of lessons on that, and buying puts. That's the brush up on that stuff.
But that's the thing, to put it all in context, don't worry about it because it's not here yet. So from a trading perspective, be aware of what your surroundings are, what the potential headwinds might be. But right now, the economy is good. We're at 2% GDP month over month. We're in Goldilocks land. We're lowering rates. There's, everything looks great. So you have to kind of put it all in perspective. You have to kind of say, well, things are okay now. So I'm going to be pretty bullish, even though we had this big rotation go on. We have names that are going up, like in industrials, financials, healthcare, like you mentioned. And that's where we need to put our capital. And if the recession comes, it comes, and we'll start short selling. We could definitely do more lessons on that when the time comes, because it's not a comfortable thing for a lot of people. Going in both directions is a great thing about being a trader, whether it's options or stocks. But some people just aren't comfortable doing it because it goes against your nature. It goes against the natural trend of the market drifting higher. But you can make a lot of money on the short side if the
conditions are correct for it.
Exactly. But if you have this underlying tide that's making the market rise, it's very hard to make money on the short side.
Yeah, we actually got a lot of questions during the ripping bull market why I wasn't calling out more short sales in the swing trades. And I was like, why? We keep hitting all-time highs every day.
Yeah, I mean, as a basket trader, and I always talk about being balanced and everything, it's very difficult for me. All of my shorts, a lot of them just kind of weighed on my performance over the year. And I felt like I had to have them because you never know, right? So I would always have at least one or two kind of bearish ideas here and there. And a lot of them didn't work out because it is what it is. The market was just, very, very strong.
So something you mentioned there, John, kind of getting back to what I said before about a lot of popular podcasts focusing on the inverted yield curve as the market was going up and ripping to the upside, especially at the end of November of last year. That rally we had basically from November through the end of March was 22, 24 weeks. And there were a lot of people talk inverted yield curve and basically talking people out of buying while this thing was ripping to the upside. Something you mentioned is no matter what your fundamental theory is, no matter what your macro theory is, you still need to validate it with price action. So this is all conversations of stuff to think about, but if price is still going up and whatever you're looking at, you still have to be long.
Yeah, this is, I call this kind of like the cocktail talk, right? If we're at a bar or at a party, what do you think of the economy? What do you think of the future? What do you think long term? These are good conversations to have and to know where we are in the cycle, in the broader cycle. But at the end of the day, you know, we're traders. We have to look at what's happening this week. We have to see what sectors are strong, which ones are not, and place our capital based on what we see in front of us, not what we think might happen a year from now.
Yeah, yeah. So heading into next week, seems like starting the week out with industrial, real estate, and healthcare seem to be most of the earnings that are coming out early within the week. The strongest sector, anybody would guess what the strongest sector has been the last 3 weeks?
Financial?
Nope.
Real estate?
Nope. Take a look at this guy. Look at utilities.
Oh, wow.
That has been the strongest sector by quite a bit, actually.
Yeah, I knew it would be an obscure one. So people overlook utilities a lot because everyone, oh, it's boring, right? But hey,
More. It's been flying last year, actually.
you could just go long XLU. Don't even pick, don't even have to pick an individual one if you don't want to.
It's funny. I didn't even have utilities on my research document for a while until AI started to become popular, because now there are also AI plays with how they're regulating the utilities.
Right. So there's two reasons why that's a double catalyst, because utilities are a defensive play normally, but they have this underlying bid from the AI side, which is interesting.
So next week we have obviously the FOMC on Wednesday, and then we also have non-farm payrolls on Friday. So there's the potential, if all things are the way they're supposed to be right now, they're both going to mean nothing. Because the economic data has not really rocked the market one way or the other, which would be non-farm payrolls on Friday. Although the last two non-farm payrolls have seen the market bounce because they came in lighter, expecting the Fed to, opening the door for the Fed to cut interest rates. But now we start getting towards the back third of the year. The Fed is widely expected to do something. So we might get a little bit more of a reaction if the numbers come in a little bit lower 2 days after the Fed meeting actually happens. If nothing happens on Wednesday, that could really set the stage for a big September meeting.
Yeah, 88%. So we'll see. But we do have, Wednesday, Thursday, you got earnings bonanza, Meta, MasterCard, T-Mobile, Qualcomm, Thursday, Apple, Amazon, Intel. So big on Microsoft on Tuesday. So yeah, big AMD on Tuesday also. So yeah, big week. So any one of those names that I mentioned could knock things around a little bit. And then on top of that, you have the FOMC right smack dab in the middle. It's going to be a pretty busy week as far as kind of what to watch. It doesn't mean they could all be nothing burgers, because we are in the middle of the summer and the market might just do what it does and continue rotating out of tech names and into some of these other spaces. So it'll be interesting to watch to see if the Qs catch a little bit of a bid on the back of maybe some of these earnings plays. But who knows? I think if you think about how long AI and the Magnificent Seven kept the market up, I would argue to say almost a year and a half.
Yeah.
So who's to say that this rotation that we're in right now can't last until the end of the year? It could. Usually rotations tend to be a little faster, but because it was such a big trade and everybody was in it, and because AI names got so ahead of their skis, I wouldn't be surprised if this continues. And trends tend to continue longer than you think they do. So this whole idea of being a little bit short some of these AI names and going long some of these quote unquote normal names, whatever you want to call them, average name, typical household names, might make sense to just stay in that trend, stay in that type of trade.
So you got to do a little bit extra work. Actually, John, before we get into a couple of picks or anything like that, and by the way, if anybody has any stocks you want us to take a look at from a stocks or an options perspective, you can start posting them in the channel right now. What would you be saying to somebody who is just started trading in the last year, and the only context they have is the raging AI market, and now the market tone and, dare I say, ease has shifted? What kind of experienced insights would you give that person?
You better do your homework, because the trades that have worked the last 6 months are no longer working. So you might get a 1 or 2 day rally in NVIDIA. That's great, fantastic. But from a swing trade perspective, it'll roll back over and then you're going to lose. So, it depends, I guess, what type of trader you are. whether you're intraday or whether you're a swing trader. But from my perspective, as an option swing trader, you need to do your homework. You need to do your sector analysis and see which areas have the strength and which ones have the weakness. And now I would start to get more bearish. I think it's safe to add bearish exposure to your portfolio on some of these tech names. And I would do it not necessarily by going short. I would maybe do some more creative stuff on the option side. You could do credit spreads, stuff that allows you, especially with volatility going up a little bit, you could start really looking more now towards credit, not debit. So what's great about options is it allows you to kind of, you have four choices. Instead of going long and short like you can with stocks, which is great, you can also do debit or credit. So you have to decide, okay, well, can I just do some call selling? So I'll do a call. I'll do a bear call spread on Nvidia, for instance. If I think it's just not going to go above a certain area, I can make money if Nvidia just stays the same. If Nvidia just stays where it is and maybe goes lower, I can make money. I like those odds. If there's three outcomes, if a stock could stay the same, go up or go down, and I'm taking a bet that a stock is going to either stay the same or go down, my only loss would be if it goes up a little bit more than I expect it to. Those are pretty good odds. So those are the type of trades I would take on the short side. That's how I would add bearish exposure without taking on too much risk. And that's one of the things, that's one of the tools in our options toolbox that we should start using right now. That's what I would tell new people. I would start, take the classes, learn the different tools that are available to you. Don't just start throwing things out there and seeing what happens. You know what I mean?
I think something you just mentioned is really, really powerful that gets overlooked, or it's such a cliche in trading that people don't really focus on the meaning of it, which is the odds of it happening. The whole point of what we do is building an argument for the odds of the profit target being hit versus, just a straight out equity trade. And I think if more people focused on not just the setup, but like how many reasons can I add to this to say the odds are higher versus mediocre, like it would shock people into stop taking so many trades because the only reason is it went up yesterday, or like those kinds of things. I think it would just make for better trading.
Yeah, I think, and one thing to realize that these names, they do have a lot of institutional ownership, obviously. So if something does go down too much, that at some point you could get a 5% rally in one day. So it'll totally blow up your short position. So you have to realize that some of these AI names could violently bounce, off whatever low happens. So, you have to do things a little more cautiously on the short side. You know what I mean? The overall market is still fairly strong. So although some of these names have rolled over, there is still that undertone. So you just have to be careful. At some point they'll bounce. You could look at AMD right there. I mean, to me, it looks a little overdone. It doesn't mean that I want to go long. It just means that I want to wait for the right entry opportunity to go short again.
Yeah. So it's interesting. One of the conversations we have in the community a lot is about short covering and how fast short covering rallies are. And
yeah, very violent.
Yeah. One of the things we started to teach a little bit was to recognize when short sellers would be caught off guard, or when what's an obvious spot short sellers would put on a short sale. And this kind of a setup right now in AMD. Now, again, earnings are coming out in a couple of days. So on Tuesday, but when a major support level is broken and the stock should follow through to the downside, and then if it within 1 or 2 days you get a reversal candle, those are usually the spots where short covering rallies can get nasty in the other direction. You can get a 10-15% move in the other direction really fast.
Easily, especially around earnings or even before earnings. People are nervous going into earnings, or maybe they'll wait for earnings to cover their shorts. That's dangerous too. Another thing to watch out for if you're going to be short, pick things, make sure you know what the short float is, right? That's a good indicator of knowing how many participants would have to cover their shorts if something was to happen. So another thing to always have on your screen or just be aware of is what the short float is in the particular name that you're shorting.
Sure, I got to find that just in case they're not aware. So you go into FinViz and you would pull up the stock, and short float is actually right here.
There you go. So
2.87%.
yeah, so that's not so bad. That's something to say, okay, so there are people that go short, but you at least it's not like 10% or 15% or something like that. So
I believe
just be aware.
Carvana has a bigger one. Carvana is 18%, almost 19.
Yeah. How about Restoration Hardware, RH? That's a nasty, or Wayfair. Those are two.
14.
Yeah, I think Wayfair is a big one. That one's like I think 20 something, or used to be anyway. But yeah, it's crazy.
Yeah, 20, almost 25.
Yeah.
Wow.
So those, I mean, that's, around earnings, you need to be really careful with something like that. So just be aware of that. It's
So
just
I'm definitely looking at financials, healthcare and industrials, and real estate to a little bit of a degree, and obviously utilities. So that there's 4 or 5 different sectors that I'm looking for next week. It's just a question of entries at that point.
Yeah, I think entries are going to be important. These markets are tough because the rotation makes it difficult sometimes to find an entry because things sold off so hard and things got bought so fast. So you have to kind of wait. Right now, just the overall rotation trade, if you want to call it, is still going on right now. So any type of pullback you get in these names that you just mentioned in those sectors, you should be buying. And as far as trying to short the AI names, if you want to at this point, you can, but you got to be cautious. I would do it personally. Like I said, in the options market, it's easier to be cautious because I could just throw on a credit spread where it doesn't have to go down that much. It just has to kind of stay where it is. So even if it was to rally that 5%, I could sit in it with defined risk and let it melt away and roll back over again. And I'll still hopefully potentially be profitable.
So one group in the real estate that we have been watching has been these residential construction stocks, which just absolutely exploded for about a couple of weeks, paused for a week, and they're actually starting to take off again, which is obviously residential construction, interest rates probably coming down in September, if not sooner. This would be a boost, obviously, to this group. So this is something to keep an eye on. Lennar, Toll Brothers, Pulte Homes, KB Homes, and DHI, I believe, is the last one in there.
Yep.
Yeah.
I mean, they just don't want to go down. When you have the big move like that, you would expect a pullback, and they just have not done it. So, and again, it's all interest rate related, all that expectation that, it should benefit that group, and it should. The question is, once rates go down, then it becomes a show me story. Then it becomes, okay, now that the rates are lower, are these names really going to perform? So then you might see a pullback at that point. That hasn't happened yet.
Yeah.
I like financials too. Like AIG is one that I'm looking at. I like that one. That's held up pretty well. And then let me see on the industrials. I got a couple of industrials that popped up. BLDR. That one kind of has a high base. It looks like it had the nasty downtrend. It broke its downtrend, and now it looks like it broke out on Friday, which I kind of like. So I want to keep an eye on that one. And here's one that I've never traded before. CNM. Talk about like kind of obscure. Also, it fell off last earnings, I guess that was, and now it's building this steady little uptrend. So these are names that could continue to move higher if this rotation was to continue as well. And the other well-known industrials look even better than these. Like if you look at like I said, GE, Lockheed, they all look great. Even Caterpillar, which was left for dead not too long ago. I've
been working this chart for a while. So I'm running out of ink over here.
Yeah, it's it had a nasty downtrend, but it had a really nice rally. So we'll see. So there are some things out there. I am finding a lot of short stuff. Look at Netflix. This is one that has not gone down as much as like AMD and NVIDIA and all that stuff, but it's kind of in that communication sector, which is, not that great right now. It was the worst sector last week, I believe. So this one looks like it tried to bounce above it just completely failed on Friday.
Yeah, it was the weakest sector last week.
Yeah, so I think Netflix still has room to go down if you want to throw in a short. Now, again, you could look at this on the short side as far as stock trading, but I could use those moving averages as where I would sell a call. So even if it went up by a couple of percent, I could still potentially make some money because the implied volatility in something like this has probably increased enough for me to get a decent premium on the short side. So that's stuff I'm going to start looking at.
One other group, John, that we've been giving a lot of attention to over the last week or so has been the regional banks.
Yep.
Obviously the JP Morgans, the Citigroups, and those kinds of stuff. But these guys, actually, Zion actually has pretty good financials as well. We've been watching this one, and you can see each earnings, it just keeps holding up and looks like it's finally rallying. So we gave everybody a huge list of specific industry groups to pay attention to on Friday. And I think 3 times this week, the regional banks popped up in our scans.
Yeah, the KBE chart looks great. I'm looking at it right now. It's a high type base, and it broke out on Friday. Really nice.
So again, this is kind of validating what we started today talking about, that, it's not to put the fear of God into anybody that Magnificent Seven isn't going up. It's just that now we have to, put on our overalls and go find the money that's not on the billboard right now.
Yeah, it's going to become, you can't skip this step. Going through the charts, going through the sectors, going through the different industry groups, you'll find opportunity on both the long and short side, but it has to be done. We always do it, but when the market's just kind of drifting higher, you could be, for lack of better words, you could be a little lazier, I guess. Now it's just not working. You have to really find those pockets.
So those are the sectors as of right now heading into next week. Obviously, knowing economic data is coming out on Friday and the Fed on Wednesday, I believe both of those are not going to be a huge factor with so much attention on September. We'll still obviously manage our risk heading into both of those numbers, but I think we're going to have plenty of earnings, plenty of sector rotation to focus on. And I think the language of the Fed after the actual announcement might be more important than the actual announcement.
Yes, the press conference will definitely be when and how many is the question that we're going to have to talk about, and that's everyone kind of priced in one. For September, it looks like 88%, like I mentioned. So we'll see if there's any language on 2, and that'll be key to watch.
Which, putting that in perspective as well, if you flash back to December of 2023, we're expecting 6 this year.
Yeah, they definitely pushed things back, and I think it was the right thing to do, kind of looking at things. The economy is kind of buzzing along, and I think they know prices are high. Like you mentioned, the average everyday person is still kind of scratching their head a little bit. So, I think kind of waiting kind of makes sense at this point, but now it's getting to where they have to do something. So we'll see. We'll see what they end up doing.
I agree. All right, everybody. Thank you so much for joining us here on a Saturday again. We'll get all the research and everything out to you over the weekend. Have a fantastic weekend. John, thank you so much for your time as always.
My pleasure, guys. Have a wonderful, wonderful week ahead.
Take care, everybody.
Take care.